Okay, so this is accounting ratios, and I'm going to do all of the exercise from this book, TS GREWAL 2021 edition. So the first sum is current ratio. That is from the following compute the current ratio. Trade receivable is we're going to get money from them right away. That is the debtors. We have some people that owe us money, so they're going to give us money. So it's a current asset for us because we're going to get money right away. Prepaid expenses, we have already paid for a service, so it's not a liability, obviously. It will also fall in current assets. By the way, current assets, fixed assets won't be falling under this category because fixed assets mean like land and building, machinery, furniture, and obviously current assets don't mean those. Current assets means like trade receivable. We're gonna get try to make money straight away. Then debtors, we're gonna get money straight away, cash, bank, and then loans and advances that we have given. So we will get the money that is the interest. So these are current assets. Just ignore the fixed assets among when you're actually calculating the current assets. So cash and cash equivalents, it's also current assets. Marketable securities, this means it's given short-term investment. So you've done a short-term investment, so it is current. Current means what? Short-term. If it was long-term investment, then it wouldn't have been a current asset. But what investment is an asset for us? Short-term means it's a current asset. It's current in general, so it will fall in current assets. Land and building, like I've said, it's a fixed asset, so we're not going to take that. Bills payable, you have to pay somebody. It's obviously not an asset, rather it's current liability. Obviously, if you don't pay them back, then we'll lose the customers or we'll lose the clients or the retailers. So we cannot afford that. We have to pay them right away. So it's a current and obviously it's a liability. Now, sundry creditors, obviously. So it's a current liability. Debentures are long-term loans. So we are not going to include that in current liability. Inventories, it falls under CA because it's a current asset. Office inventory basically means stock, and stock is an asset. And inventories are like raw materials that's going to be used up anyways, right, to manufacture products. So they're short-term inventories, so short-term assets. So CA. Expenses payable, we need to pay somebody, so it's current liability. So this is how the sum would look like once you do it. That is how I've written the formula. Current ratio is equal to current assets or current liabilities. And that is, this is, we have to calculate this part from this working note. This current assets, all the things that I've written like CA. That is, if you can see straight away in the question, this one trade receivable, I've written trade receivable there. Prepaid expenses, this one, cash and cash equivalent, marketable securities, inventories as well, and then just add them up because they're all current assets. So if we calculate them, then we can get the actual head, that is the current assets. These are the subheadings. In the same manner, we have the current liabilities as well. In the same way, with current liabilities as well, that is bills payable. This one, then we have sundry creditors, then expenses payable, and we're just gonna add them all. And once we add them up, we have this one in right up. We'll put these in the formula, values in the formula, and we'll have our current ratio.